The United States effectively loses the Iran war, signing a plan that includes sending $300 billion to reconstruct in order to avoid economic catastrophe. According to President Trump, Kevin Warsh begins his new role as the chair of the FOMC as a hawk, not as a dove, as many were fearing. I'll be talking about why I think he's more of a fickle hawk and could easily switch to becoming overly dovish. But for now, the committee and Warsh came out today very hawkish. So yields went up. Fed funds futures sees more and earlier hikes. And the stock market fell. All that and more coming up. All right, everybody. It's Wednesday, June 17th, 2026. Our first headline today is Warsh the Fickle Hawk. So before Warsh's conference, where he spoke and answered questions, they had the press release at 2 o'clock. They kept rates steady, but the more important part is that it was a very short statement. It blamed more recent inflation on the Iran war, which is why they didn't raise the rates, nor were markets expecting them to. But the real kicker was the last sentence: the committee will deliver price stability. No fancy language about talking about the balance of risks and all of that. Just straight to the point: the committee will deliver price stability. This was the part in question. The market was asking, okay, Trump put him there. He has literally said on camera over and over again he wants lower rates. So the FOMC said, calm down, everybody. We're going to keep prices stable. I did a live stream of the conference, and in a nutshell, by his tone and demeanor, I don't know how everyone else feels, but I personally got the feeling that he was sort of pushed into the hawkishness, or at least is trying to show that he was pushed into the hawkish side. After all, if markets do turn bearish and President Trump calls them up, he can say, well, it's not me, it's the committee. They pushed me into being hawkish. And the reason that I am referring to him as a fickle hawk is because if you watched the FOMC conference, he mentioned the market more than once. It was 3 or 4 times, maybe even more times than that. In a nutshell, what he had said was, well, as long as the market's going up, we don't have to cut. And if it's going down, well, guess what? We're probably going to cut. And I personally get a little bit nervous about that. The Federal Reserve losing credibility. Say inflation continues to be higher and the stock market is falling. What's stopping him from being the stagflationary chair? But it really doesn't matter what I think. What matters is what the market thinks. And the 2-year Treasury note yield rose 13 basis points today, up to 4.18. This is the highest close since February of 2025. And what matters more than anything is yields, is the bond market. What do they think of what's going on here? The 10-year rose 5 basis points. Not a lot. It's back to the range that we've been in for a little while here. Looking further out into the bond market, into yields, the 20-year Treasury bond yield only went up 1 basis point today to 4.95. And the 30-year bond yield, believe it or not, dropped by 1 basis point today, a little bit lower than the 20 years. Yeah, so you have a little bit of backwardation between the 20 and 30 year, sitting at 493. So that's why TLT, my favorite place to be, was actually able to go up 16 basis points today, believe it or not. But anyway, I believe as of yesterday, we only had 1 hike, and it was further out. And now it looks like we have 2 hikes, and the first hike being in September. The Fed funds futures are there for 3 sessions, and then by end of January of 2027, they see a second 25 basis point hike. If you've been following markets for a while, you know this can change a lot very quickly. Now, stocks did fall today. It was tech that actually held up the best over the day. Information technology only going down 0.6%, while consumer staples went down 2%, consumer discretionary almost 3%. The reason for this is that areas of the market that borrow on shorter term, when their debt rolls over more quickly and that more of their debt is shorter duration, well, it has, when the shorter yields go up more, then it puts more pressure on their earnings. It elevates their debt costs versus tech, which has usually longer dated debt. And so, with a 30-year bond even dropping by 1 basis point today, that's why tech was able to outperform the other sectors. Second headline, America loses war with Iran. What else can you say? $300 billion for reconstruction. Many would call this a taco, with Trump saying Iran deal avoided global economic catastrophe. That's why we're leaving. Nothing in the deal gives any kind of strong wording as to what kind of guarantees there will be for Iran to not have nuclear bombs. So I guess we'll see what happens moving forward. Strait of Hormuz traffic returning to normal odds actually dropped a little bit further today. By the end of July, we still only have a 56% chance of returning to normal. But for now, it's expected that we'll at least have more crude oil going around the world, with crude oil falling a bit more today, down to $75 a barrel in the WTI. On to community topics. What moves, if any, did you make today? Did you buy anything? Sell anything? I sat on my hands. Coming up tomorrow, we have the LEI, Leading Economic Index, alongside the Coincident Economic Index. These are the next big thing, along with quad witching. We have a bunch of options expiring tomorrow. So that typically means an overly orderly market on high volume. And it's on Thursday because normally it's on a Friday, but it's because Friday markets are closed for Juneteenth. Also coming up, end of the war. When will the Strait of Hormuz open? I'm still going to leave this on here. The Strait of Hormuz is more open. It's not all the way open yet. So I'm not changing my stance on this yet. Also, don't forget about the Trump tariff saga. Thank you for watching, liking, subscribing, sharing, commenting, and all of your support. Greatly appreciated. I saw some headlines saying that, markets are crashing. And it was a good-sized move down on one hand. It's down 1.2% in the S&P 500. But if you look at it structurally, we're still just going sideways. This is not like breaking down. If this was really looking like it was getting super bearish, we'd need to break this low. We need to break this line here to the downside. We haven't done so yet. As far as I know, this could be a buyable dip for Mr. Market. After all, the narrative for now is that the Iran war is ending. So, that was my thesis, and it's been my thesis for a while that would be the catalyst to potentially get us up to the standard deviation for 2026 to 8,000 in the S&P. So again, with shorter yields going up, that affects especially consumer discretionary, going down 2.7% today. In recent history, most of these drops, whenever the market has been getting bearish, it was being led by tech. And this was not a tech-led sell-off. It was the opposite. In fact, the S&P 500 going down 1.2%, RSP equal weight went down 1.5% more than the market cap weight. We already talked about yields and TLT. Moving on to Bitcoin, I said in yesterday's show we would need Warsh to be unusually dovish, surprise the market to the dovish side in order to continue higher towards this yellow line, which is the bottom of a giant bear flag. We're rolling over. Professor Bitcoin, the liquidity oracle, is falling. And speaking of markets with titles, one of the most famous ones, Dr. Copper, the PhD in economics, fell by 1.74% today. I have discussed on this show Looks like we may have a head and shoulders top. It looks like that's what it looks like. That's still the pattern in play here. With yields rising, it makes the dollar stronger. And so the dollar had a very green day today, going up 0.85%, highest since the end of March. You can see we kind of bumped our head on this level that we've been sort of bumping on for a while. So is the dollar about to rip higher from here? I don't know. I guess we'll see. But alongside copper, silver also fell almost 3% today, and gold down 1 2/3%. Speaking of head and shoulders tops, I know, guys, I see them everywhere. Nvidia, the king of the stock market. I don't know. Looks like it looks a bit head and shouldery to me. Of course, we have to break the neckline and do all the stuff necessary to show we're going lower, but we're headed there for now. So easing the worries that Warsh might be too dovish, and therefore inflation might go to the upside out of control. Well, guess what, guys? The break-evens, they fell today. The 5-year break-even inflation rate fell sharply by 5 basis points to 2.31% today. This is the lowest since January. And yes, I know PCE and CPI and PPI, those are backward looking. The market is pricing forward looking when they're looking at the break-even inflation rates. And these are collapsing. They're falling here. And I don't know where they're going to stop. They haven't stopped yet. In fact, they accelerated today to the downside. It wasn't just the 5-year. Even the 10-year also fell by 3 basis points down to 2.26%. Officially breaking below the entire Iran war. Is it going to stop here? Are inflation expectations through the break-evens going to stop and reverse and go to the upside? I don't know. Right now, it still looks like it's falling pretty sharply to me. But as always, guys, remember, I'm just a guy with a crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.